So fundamentally, it's a muddled picture. Subsequent on the Fed, and the jury seems to be out on respect to whether the Fed will hike rates um, if the inflation picture picks up and we see less disinflationary scenarios in the market. Powell, he failed to push back against dovish market expectations, and it was a very muddled picture. So markets have essentially jumped on what they wanted to hear, um, and they've been positioned for a less hawkish Fed. So getting 8% down to 4% is the easy part, but getting it from 4 to 2%, if inflation proves stickier, well, that's the question that's left to be answered. So it's a pretty muddled situation. But the swaps market, the bond market doesn't lie. It's still pricing in an easing cycle for the second half of the year. And that puts the focus on today's data. We've got non-farm payrolls and services. So with regards to the non-farm payrolls, a tight labour market is expected to continue, so the data will be of no surprise if it comes in strong. And it could be that the market is asymmetric around this number. That is, that a positive surprise is not likely to materially derail risk sentiment, but an indication of softness could reinforce it. So, not an easy one, this today. So, looking at the charts, really. But before we go there, so to explain that, so a softer number would reinforce the disinflationary prospects and potentially lift risk sentiment and weigh on the US dollar. But given that the market is anticipating a pivot, regardless of this data today, it may not even be a mover on a strong number. That is to say that the US dollar might not even catch a bid on a strong number. But what might reinforce a stronger dollar could be the services data. If that comes in poor today, coupled with a series of misses in prior data, if we were to get a poorer than expected outcome in the jobs data, coupled with a poor outcome in services, coupled with all of the other disappointments, such as the ISM manufacturing that came in weaker than expected, then all of that could set off the fears of a hard landing in the US economy. So such fears would be negative for risk sentiment and positive for the US dollar. Now we'll look at the stocks in a minute, but speaking of equities, I mean, we had this failed breakout above last week's high. So we've got those longs that are trapped, and we had this lower close on an inside day. So that puts the bias to the downside. With traders trapped above the 78.6. So we've got that resistance in here. And as we can see, we've got this M formation on the hourly. Bit of a skewed M over there, but if you to count that as a bullish candle, depending on your broker where that closed, you've got the correction up to come down, so the pump up to the dump. If we draw our fibs on this, with the 20 and the 50 aligning potentially, so that could be an opportunity for a day ahead. and the data will count. So there's nothing to do until the data is released. We might want to wait till services to do anything and trade the cash open. But let's see what happens on the non-farm payroll. So moving to the currencies, taking Aussie first up, we are on the front side of the bear trend. So we're bearish while below this. It's a first red day, so we closed lower yesterday. We have broken structure on the downside in today's business so far, with London pumping up into shorts. The first red day is to try and sell at the high of the days for a continuation of this down move. As we can see, we've had a number of lower closes, so the bias is to the downside with the failures. First red day following the prior day's update, continuation lower. With the euro, we saw that spike up, pull back for a first red day, similar setup to the Aussie, targeting the dominant trend line, but meanwhile support down here. This block, we've got last week's lows over here. We're on the front side of this bear trend, very similar to the Aussie. We've had a break in structure in the London session here. We've had the pump up, anticipating the dump. So we're pumping up again in New York. Moving through last week's highs and trapping bulls. Same scenario for sterling, break of structure, pump up for the dump, low of the day, high of the day, last week's highs, 38.2 of the retracement of that daily. Again, another first red day, looking for the continuation of that sell-off. Distribution area structure's been broken on the downside with that dump. So the structure below is the target. 2150 for 100 pips. ATR 120 pips. Dollar Swiss. You've got the bullish M formation on the daily over here. So that's the M formation harmonic pattern moving up into neckline support. You've got this channel that it's sort of chopping through, looking for a retest of the upside on that. We've had a first green day, so looking for the bullish continuation of yesterday's business. We've had the break of structure in the London session clearing away. We've had dump, so now we're looking for the pump up. And we've got the structure at 91.35, higher, 36, and you've got the yesterday's highs turning as well, turning in here. Dollar yen potentially face breakout, false breakout to the downside, plenty of daily support over here, wedged in this symmetrical triangle on the front side of the daily downside, so any moves to the upside could be short-lived. You've got the 38.2 and the 50% as the target on the upside. Got a daily ATR of 160 points. So false breakout, looking for a move up before we move back down from resistance areas. The daily. So looking for a first green day close potentially to end the week, for a continuation up before we move down. Dollar CAD, we've got the first green day continuation. Breaking structure on the front side of the bullish trend still on the hourly chart. This was drawn before the price action, so we're already seeing a jump through that resistance that's now broken. It's moving up as anticipated. This is the Fibo of that move up, so we're being supported at 61.8. We had the break of structure in London, we had the dump, and now we've got the pump. Overall, this is a first green day continuation trade, front side of the trend. And in gold, it's a first red day continuation trade. We've got this market that is consolidating below resistance over here. It's pumping up currently, possibly for the dump lower. We've already had the break of structure, so that's the bias for the day to the downside. And here, that's my dog snoring in the background. So this is a continuation of, if you look at the YouTube channels video, the pre-market analysis for the week is talking about, we've got this 100,000 pip box to the downside to exploit. Bring this up on a daily, more clear. So we've failed to break out of the January initial balance range. We've got 1, 2, 3. Higher, so months of length, 1, 2, 3 months of the up. So with this big fat candle breaking this here, we've also got the 3-line strike that was over here. So we've got bearish momentum candles in play. We've got this first red day, so we're looking for the continuation in to test the dominant trend line, penetrating into this 1,000 pip box, and we are testing last week's highs. last week's lows, trying to break through that. And moving back to the Dow, we've got the break of structure, and we've got this pullback in play, and we're looking for the rollover. So we'll leave it there. Good luck for today. Remember, services will be very important given the stark miss in December, 49.6 point versus 55. So that was a terrible number. So more of the same could actually spark off a move in the dollar higher, which would play into the thesis technically that we've spoken about on these charts.